Hey guys, glad to have you here today. This week, after the markets took a tumble, we're going to be talking about really what happened here this week, some of my thoughts, some just kind of generic news as well. And after that, we're going to be touching on a company that I actually haven't talked about here before, which is Cooper Standard, ticker symbol CPS. And we're going to be kind of diving into specifics there, why I like that company, what's kind of pushed it to the position it's in. So with that, guys, we'll kind of jump right in. First, you guys can see here just this heat map of this week's market, and you can see there is a lot of red. Nvidia this week alone was down 13.5%, with Broadcom down a little over 10, Qualcomm, AMD. You can see semiconductors just really got hit. Even Microsoft, Apple, Google fared much better than the markets, but still down. Meta. You can see one of the standouts here was healthcare. And I mentioned this last week on the call, but UNH, unfortunately, is probably going to run away. It was a company that I was paying attention to, but it's probably going to run away at this point, as people realize it's just such a high-quality company and isn't going anywhere anytime soon. So a lot of red in the market for sure. This week, the S&P was down, about just under 4% for the week, which for a long time it just seems like the market has just been going up and up. Really, since this low in October of 2023 has just been on a tear. So in the big picture, hey, it's a move down, but it's not really anything major, as you guys can see here. This looks like a normal pullback when you compare it to here, when you compare it to here, especially when you compare it to crazy dips like in COVID and the longer term downtrend that we had in 2021 into 2022. So gives you guys kind of an idea of what things look like. Obviously this week there was a lot of kind of change in tone, I would say, as people are starting to get the feeling that we're going to be staying higher for longer. And that's kind of weighed on markets as rates have kind of climbed and continued their uptrend, pushing higher and higher. The 2-year, as I talked on my last video, hit 5%. People have just been more pricing that in. There's also been more geopolitical risk between Israel and Iran. I don't know how much that actually will affect the earnings of companies, which is really what I want to focus on here in my channel. I want to talk about those other things because I think they're important to understand. But really, when you're looking at a company, all that you should care about is their fundamentals. And when I say fundamentals, are their sales growing? Are they generating cash flow? What does their leadership look like? What does their debt load look like and those interest payments? And if you can understand what position the company's in and you see that they're a good value, it shouldn't really matter what you think may happen, because really no one knows what is going to happen. No one has any idea when a recession's coming. Not really. And if people are claiming they do, they're just lying. To be frank, people do not know. And there's going to be flashes in the pan that maybe you look back and say, but this person has made predictions, the last 2 times and they got it right or whatever. But really, they're just flashes in the pan. If you look at any successful investor that's been really, really successful, I can only think of people that have this long-term mindset of, hey, we're buying companies when they're undervalued and riding them for the long term. They're not the people that bet on terrible things happening and get it right every single time, because usually those people just blow up their accounts. So that's what we're about here and why I think it's important to have a long-term view. And when we're looking at these charts and things, having a long-term perspective, you can really see there are times when things do not go well. But in the long run, if you're invested, then you can really make a lot of money. And the idea is to not just buy index funds, in my opinion, unless you're someone who doesn't want to pay someone, but you still want to do it yourself, but you don't necessarily want to be a full expert, then index funds are totally fine. But if you want to do the work, buying individual companies that have moats, and you're going to outperform over the long run, which is really Warren Buffett's whole theory. So with that, onto some more generic news for China, which you guys may know I have position in Alibaba, and I'm paying attention to China. I just think it's a fantastic value investment right now, especially when compared to many others. And there's some news right here. China's economy grew 5.3% in the first quarter. I think people just have so much pessimism around China right now, but it continues to prove itself that they are not going anywhere. And this is, in my opinion, without even the citizens really bringing out their checkbooks to really spend wildly. They were still able to grow. And I think that they have a lot more room than people are giving them credit for. They are the second largest country in the world, and they're continually bringing all of their citizens, pushing people up to the middle class, bringing people out of poverty. There's still millions and millions, tens of millions of people in China living in poverty that they can pull up. And I think that they still have a ways to go. Even with population decline, it's not really going to start getting really bad for several more years. So I think they still have some room to run, and I wouldn't kick them out of the race. So another piece of news on China, Bank of America actually upgraded what they feel like they can do. They said that they could grow 5% this year after a surprising first quarter performance. People are really waking up to it, and we'll see what happens. Alibaba and China in general has just been absolutely destroyed over the last few years, so we'll see what happens. Another company that I actually tweeted about, or X'd about, whatever it's supposed to be called, GXO Logistics, and I have Thomas Hayes to thank for pointing out this company. I probably would have never found it on my own, since I'm looking for companies that are down even more than this is from their all-time highs. But GXO Logistics, their stock target was raised on M&A prospects. I'll be touching and hopefully doing a little bit more of a deep dive on this company in the future, but their CEO is known for being really, really good at making profitable acquisitions and integrating them very well to drive the company forward. Whereas I think a lot of other companies just kind of make acquisitions because they maybe don't know what else to do. But this guy knows what he's doing. He has run more than several companies that have gone and IPO'd billion-dollar companies. He's done it many, many times, and I don't think this one is going to be any different. It's down, I believe, about 50% from its high, but I just wanted to touch on it with some interesting news around GXO, and just kind of highlights their strengths. Alibaba, like I just touched on, they launched a logistics marketplace for US SMEs. So this is really just Alibaba coming out with another line of products that they are offering small to medium-sized US companies their expertise in creating more efficient supply chains globally. And so they're allowing US companies to kind of tap into that to become more efficient, and we'll see where this goes. I don't know how big this could get, but kind of is a little cherry on top for what Alibaba is and what value they provide. Another chart that I wanted to show, this is for IHS, another company that I own, that I've done a video on previously. And one of the biggest things that's hurt them is they get a lot of their revenue from Nigeria. They are a cell tower company, so they have tons of towers in Nigeria. They're by far the number one provider there. And one of the biggest things that's hurt them is the devaluation of the Naira compared to the US dollar. And over the last 60 days, you can see it has made a pretty strong recovery. Now, this is still just a small drop in the bucket for how devalued their currency has been, even just over the past 180 days. But it's making progress, and I think it's probably a good sign that maybe things are stabilizing there a little bit. This is going to be a long process, but I think it bodes well, and thought it was worth bringing up. So that's kind of some of the general news that I wanted to share with you guys. And we're going to go from here into talking about Cooper Standard. Cooper Standard is a really interesting company, you guys, and I thought it would be great to share with you guys some of my thoughts on this company here, because I think it presents some presents some really interesting value at this price. I really wish I had seen it maybe a few months ago, as when it was far lower, although there was more risks, but we'll kind of jump into that. So Cooper Standard is a company. They design and manufacture sealing, fuel, and brake delivery, fluid transfer, and anti-vibration systems. So they provide a lot of these kind of pieces for automobiles they wouldn't necessarily think about, but they are a major supplier here in the US for some of the biggest brands. So a really great company, and you can see how far they have fallen from a high of almost 150, falling down all the way to lows in here in the threes, and is now much higher than they were before, sitting around 16. But even this has fallen from recent highs, so they have fallen a long ways from where they were before. And the biggest reason why this company had a big fall was just due to straight solvency risk. As they fell there from COVID, there was just a lot less car selling, their revenue fell, and they had to take on more debt. Their cash flow was negative, and just really they were in jeopardy of going bankrupt, which you can imagine is why the stock price fell so low. But when you really dive into their numbers currently, you guys are going to see why I think now presents a really interesting opportunity. So currently, this is their debt situation and their obligations between interest, operating leases, finance leases. So in less than a year, they will have about $146 million coming due. In 1 to 3 years, about $305 million. In the 3 to 5 year, about 1.1 billion coming due on the debt side. Now, they have been free cash flow negative for quite some time, but are just turning the corner. In the last 3 months, in their most recent quarterly report, they actually reported free cash flow of $62 million. So they're turning the corner here, especially compared to 2022. They had negative free cash flow, $38.4 million. So they're turning the corner here, becoming free cash flow positive. And this, guys, is that 62 million. If they were to do that for 4 quarters in a row, would actually put them at record free cash flow levels. Previously, they had around 200 million was their record high free cash flow. So it's really interesting how quickly they've been able to turn the corner, but gives you an idea of what they're able to do. And that 62 million in 1 quarter, you can see in the current year, they have $146 million coming due. If they're producing 62 million in free cash flow in 1 quarter, that makes this look like not a big deal at all. This in the 3 to 5 years may be a big deal. They may need to push some of it farther out, or maybe they'll be even better than I think, and they will have no problem just paying that with their free cash flow. On top of that, they also have current liquidity sitting at $317 million, just between the cash they have on hand as well as other liquidity that they have available to draw from in loans. So gives you guys an idea. Their situation currently with $317 million of liquidity, generating in the past quarter $62 million in free cash flow. I think this debt here above starts to look not so bad when they can cover these first 2 in just free cash flow alone, and they still have liquidity on their balance sheet to take care of this and to push it out. You can see I didn't touch on the more than 5 years, but it's basically nothing. No long-term debt, no interest. It's just leases. So other things that I wanted to touch on that make this a really interesting opportunity for me was the automotive industry in general. This is the total vehicle sales in the US. And in here, in this total vehicle sales in the US, you can see going all the way back to 1976, kind of the cyclicality of these different trends and kind of the rise and fall here that we see. And I think right now presents an interesting opportunity as we potentially start to come back towards maybe this style between 1990 to early 2000s, where it's just kind of a slow, steady incline of total vehicle sales, which bodes really, really well for Cooper Standard. You can see here from 2015 really until now, we've kind of been on a decline with obviously a sharp fall during COVID and a further decline in 2021. If we kind of were to average this out, it would be another drop down here. But has since been recovering, and this is one of the reasons why they've been able to turn free cash flow positive again. And I think this bodes really well. The cyclicality tells me, hey, after these downturns, things bounce back. People are going to continue buying cars. This is not going to be going away anytime soon, and could be really interesting as these bull runs or these slow increases can last for quite a while. So could be interesting. Something else that confirms this is the total automotive sales, and you can see this right here, the lightest line representing 2022, middle 2023, and this blue in 2024. It has continually been increasing each year, and I expect this trend to continue, where the 2024 sales volume will just continue this trend. It will continue increasing. And another piece that indicates this for me as well is the number of licensed drivers there are in the US. And we've got down here this chart that tells you how many drivers there are licensed in the US. And you can see from 2019 to 2020, basically flat. A small increase in 2021, basically flat to 2022, and then it's from there that we start to see a decent increase of about 3 million new drivers coming into just this pool in the US. And they expect this to continue with another 3 million gained in 2024 and another 3 million gained in 2025. And as there are more drivers that come out here, obviously more vehicles are going to be purchased. So I think this bodes really well for the continued trend of improving automotive sales in the country. So just kind of some pieces that tell me, hey, things have gone down and this company did go through a rough period, but things are looking up, and they are looking up for the long term. This company doesn't necessarily have the same solvency risk that it had before. They have things lined up to draw from, cash to draw from if they need to, and they just turned free cash flow positive, which bodes really well. So with that, coming back here, along with the tailwinds, there's also some great information regarding their cost structure and a deal that they made with Nike. And these are kind of just some cherries on top that kind of pushed me over the edge to feel like this is a really, really great opportunity for myself. So some of the cost cuts that they did in 2023, they said that they were able to deliver 56 million in cost savings, which is on top of the 185 million in, quote, sustainable cost reductions that they created in 2022 and 2021. And it might not sound like a lot, but from their peak free cash flow of 201 million, if all of those cost savings were to fall to free cash flow, that would mean surpassing their previous peak by 130%. Anytime cost cuts are made, they are magnified by many multiples of increase when you get to their bottom line. I think this bodes really, really well for this company, and also kind of gives some explanation as to how they were able to turn cash flow positive so quickly. They were able to take out a lot of cost from their business to get more efficient, and I think it's going to really show up in their numbers going forward. They also made a deal with Nike. This is one that I have no idea how big it's going to be for them, but like I said, it's just kind of a cherry on top. In their call, this is all quotes from their most recent earnings call, where their CEO said, quote, "The simplest way for me to describe this deal is Nike asked us to put together a deal that would allow them to go faster in developing products across their portfolio. we have a royalty stream set up based on their volumes. So as their volumes go up over a period of time, that's how we get paid. The analyst then asked, it's just a straight 100% cash, 100% margin cash flow business. The CEO said, that's correct. Yes, we've got no investment. I think this is, again, going to be a situation that will allow them to increase their margins. They essentially just sold their licensing on the chemistry for some materials that they make that Nike is going to be putting in their shoes, and they're going to be getting royalties from it. They have absolutely no investment, no cost to them. And whenever you're adding a 100% profit margin piece to your business, my bet is it's going to drive up your margins. That's just what's going to happen. I don't know how big of a player it's going to be, but like I said, it's just kind of a cherry on top. We're mainly focused on the value that their automotive components are going to provide as those sales ramp up. But this could be something really nice that's going to increase their value and allow them to generate even more cash than they were previously. So kind of as a review, the current trend of increasing automotive sales will be the main driver and of a return to normal. But the cost cuts and the deal with Nike, which is 100% profit, like I said, will be a fantastic cherry on top. The company currently has a market cap of $264 million and just generated $62 million in free cash flow in one quarter and looks to be headed to surpass their free cash flow of $200 million in the coming years. Just based on the last quarter's free cash flow, they are trading for only 4.3 times free cash flow. And that's just based on a single quarter of free cash flow. At their peak valuation, they reached about 20 times free cash flow, which if they can just match that on free cash flow and multiple, would mean a market cap of about $2.5 billion. And that's why this presents one of the most exciting opportunities in my portfolio. Guys, I hope this was really valuable to see my thoughts around Cooper Standard. But just because some random guy on the internet is going through all this and talking these numbers does not mean you should buy it. Go out and do your own work. Please, this may present more risk than you're willing to take on. So really understand a company before you go out and purchase them. But hopefully it was valuable seeing kind of the details as to why I decided this company made a lot of sense. You can see from my analysis there that I think they present a lot of opportunity and in my opinion, pretty obviously are on the trajectory to surpass their previous record free cash flow of around $200 million in a single year. So with that, guys, I really hope this was valuable. Again, let me know if there are any companies that you want me to kind of look into or any information that you think would be valuable to touch on here. Definitely want to provide any information you guys think is valuable. And I'm always going to try and put a ton of work in to make these videos as good as possible. If you think these are rough, let me know. But again, thank you guys for being here, and we will see you in the next one.